this line holds, the bias is very bullish. If we get back in this zone, it's more of a neutral to bullish. And then if we broke below 3150, then you want to be a little bit concerned on gold. So again, as of now, strong bullish bias here with upside easily to four, maybe $5,000 over the next year or two. Silver obviously isn't as rare, but it's basically the poor man's gold, meaning that it's going to play catch up with gold here. I do think again you're probably seeing a little bit of a short squeeze in general. Upside, I have this pivot that I'm watching very closely at around 37.50 for a short-term pullback, and then if it breaks through there, we probably go to that $50 level, which historically has kind of been your topping point, right? $48 to $50 right up here. We can see that was your high back in the 1980, and then we briefly pierced it right here in 2011. I think eventually we go up and retest that level.
Gold has been holding steady at around $3,300 per ounce after a rapid rise from $2,500 to $3,500 since late 2024. Gareth Soloway and other market experts see this period as a healthy pause, where the market is digesting strong gains rather than reversing. The key level to watch is the $3,150 to $3,200 range. If gold stays above this level, the outlook remains very positive. Ongoing concerns about inflation, rising U.S. government debt, and uncertainty surrounding the dollar's strength are prompting investors to seek safe haven assets, such as gold. These pressures are unlikely to fade soon, so many believe gold is positioned to push toward $4,000 and even $5,000 over the next year or two as demand for reliable stores of value intensifies. Gareth is even more bullish on silver, which has surged past $37, reaching heights not seen since 2012. He highlights that silver often follows gold's lead early on, but then outperforms as momentum builds. The gold-to-silver ratio has declined sharply from its historically high levels, indicating that investors are reallocating capital into silver. Market trends and strong positioning suggest this rally still has room to grow, with some analysts forecasting prices could rise to $60, given the metal's performance in previous breakouts and the present market conditions. What sets silver apart currently is the surge in its industrial demand, particularly in the clean energy and advanced technology sectors. Silver's exceptional conductivity makes it essential for manufacturing solar panels, electric vehicles, and various electronics. The demand from the solar industry alone has more than doubled since 2022, now accounting for roughly a quarter of total silver consumption. At the same time, silver mining production has remained largely flat, and above-ground stockpiles are steadily declining, which tightens the overall supply. This rare combination of increasing industrial demand, limited supply growth, and rising investment interest emerges at a moment when geopolitical risks and fiscal challenges are eroding confidence in traditional safe havens. Now, we present the clips from Gareth's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
As of now, it's bullish consolidation. There's no doubt about it. Right now, you have this longer-term trend line down here that goes back to December of 2024. It kind of started there around 2,500, took us all the way to 3,500. Notice that the move from here just about 3,000 to 3,500 was very steep. Those type of vertical moves that come at the end of longer-term uptrends, those need digestion, and digestion is a term that means consolidation. It needs to digest the big move up, and so that's what we've been doing here. And what you can see here is you have a trend line that connects that 3,500 high to this secondary high here and this third high. Notice we've been consolidating in there, and then recently we went above, and now we're staying above that line. As long as this line holds, the bias is very bullish. If we get back in this zone, it's more of a neutral to bullish. And then if we broke below 3150, then you want to be a little bit concerned on gold. So again, as of now, strong bullish bias here with upside easily to four, maybe $5,000 over the next year or two. Just watch your levels. As a trader, for me, the 3140, 3150 level is a line that sticks out. I want to see the trend. Basically, the trend needs to hold there. I would say right now it would be gold with a spattering of platinum, palladium, and silver. But I know that wasn't part of the question. But again, those haven't run as much as gold, so I actually like them, and they've started to play catch up a little bit here in the near term. Bitcoin, because it's a risk asset with stocks, I classify it as one of those, meaning that if I think the stock market's going to pull back, Bitcoin likely will as well. Longer term, if you ask me over the next 10 or 15 years, Bitcoin would be the answer. But shorter term, 3 to 6 months, I would be still long gold. The silver gold ratio has been very, very low historically. We've seen this with platinum and palladium as well. They're starting to play catch up. They're both rare. Platinum and palladium are even rarer than gold, yet they were, priced one third of the price of gold. Silver obviously isn't as rare, but it's basically the poor man's gold, meaning that it's going to play catch up with gold here. I do think, again, you're probably seeing a little bit of a short squeeze in general. Upside, I have this pivot that I'm watching very closely at around 37.50 for a short-term pullback. And then if it breaks through there, we probably go to that $50 level, which historically has kind of been your topping point, right? $48 to $50 right up here. We can see that was your high back in the 1980, and then we briefly pierced it right here in 2011. I think eventually we go up and retest that level.
Interesting. Do you think then that silver is going to be an outperformer relative to gold for the next couple of months or
I
weeks?
do. I actually do. Yeah, I do. And granted, it's already done quite a bit. I mean, percentage-wise, silver's had a massive move in just the last week or so, going from below 33 to now 36. So that's 10% right there. But I do think there's more fuel in the tank here for silver, as well as some of these others. Just to show you quickly the palladium chart here, which is a pretty remarkable chart. You can see here, I mean, zooming out, look at how low palladium was. And if you look at gold, gold's trading up here, $3,300, right? But look at how palladium is been grinding lower. Yet palladium is about 30 times rarer than gold, as is platinum, right? So granted, they're more industrial metals, which is why it's been lagging. But for me, as someone who wants to diversify away from fiat as much as possible, something about rarity does matter, right? Rarity does matter. And then if we zoom in, look at this. Hits here, pulls back, hits, pulls back, hits, pulls back, breaks out, retraces to the scene of the crime, which is the classic setup. This is your buy right here, and then boom, to the upside this go. So I could easily see, palladium and platinum north of 1500 in the not too distant future. Yeah, so to me, this move is not so much related to industrial, production or the economy. It's more of a where is gold? Gold has run X amount. What
Hmm.
hasn't run that is still a rare metal? And that's where these other metals are playing catch up. And this is something we see in the stock market, right? You'll see Nvidia make a big run, and then all of a sudden the other semiconductors are like, oh, Nvidia's running, we got to play catch up, and they'll run after it, right? So I think that's more of what this is. It's investors chasing, but that certainly gives us an opportunity here to play that catch-up trade, and it's working so far on these other metals. Bonds, meaning I think yields are going to go lower. And just to show you the chart here, we have this nice wedge pattern where you're basically connecting this low back from April. So this was the low in April before we saw that big spike. We then came down again, we pushed up, and notice right here what has happened. We've broken below this trend line, consolidated, broke down, and now retraced to what we call, again, the scene of the crime. We just talked about it on that palladium chart. And what it tends to happen when you do this is resistance, and it's going to reject price, and price is going to fall. And in this case, it's the 10-year yield. And so what this tells me, and interestingly enough, you can extrapolate that if the yields are going to fall, it tells us that the U.S. economy is likely going to weaken further, which again means more rate cuts potentially. And that again is the direction. So I'm looking at being short on yields, but that would mean buying of bonds.
Gareth Soloway anticipates that the Federal Reserve will postpone any rate cuts despite political pressure to ease monetary policy. Inflation is expected to rise soon, driven largely by changes in how businesses manage their inventories. Before tariffs were imposed, many companies stocked up heavily, and the recent temporary rollback of tariffs gave them another chance to buy in bulk, which has helped keep prices steady for the moment. However, if tariffs remain in place permanently, inflationary pressures are likely to become more apparent. At the same time, lower energy prices, particularly oil trading in the low to mid $60 range, have helped contain overall inflation, partially offsetting increases in other areas. Meanwhile, the stock market is showing strong bullish momentum, with the S&P 500 closing in on new all-time highs near 6,000 points. This optimism is largely driven by retail investors and hedge funds responding to ongoing stimulus from the Fed and the government. Since the market lows in March 2020, retail investors have become conditioned to expect sharp rebounds after sell-offs, creating a pattern of rapid recoveries. Hedge funds, having stayed in cash, are now rushing to increase exposure ahead of quarter end, adding to the market's upward push. Despite this, Soloway warns that the S&P 500 is approaching a major long-term resistance level, a trend line historically associated with significant market downturns, such as the Great Depression and the dot-com crash. Given signs of a slowing economy and historically stretched stock valuations, the risk of a meaningful market correction rises once this level is tested. While there may be room for some short-term gains, the broader picture suggests a pullback and market revaluation are likely in the months ahead.
I do think the Fed will delay rate cuts. Now, I know Trump is pushing for them to cut, but my thesis here is that we will still see a bump up in inflation. Now, a lot of people would say, well, why haven't we seen it yet? Well, remember that before Trump imposed these tariffs, a lot of businesses bought a massive amount of inventory. And when he's rolled back these tariffs initially and given another 90-day window, businesses are buying massive amounts of inventory again. And so what they're doing is they're buying the inventory essentially pre-tariff, and that enables them to keep prices relatively stable, and that's why I think we haven't seen the inflation. But if the tariffs do ultimately end up sticking, then I do think that the inflation will start to show up. The other thing to keep in mind is that while we're seeing inflation in certain things, we're also seeing oil and energy prices go down, and that's really anchoring and pulling down the overall inflation number, right? So oil again trading back in the low to mid 60s, and that again is historically, at least over the last 5 to 10 years, relatively low, and that's keeping pressure on inflation. I think the key here is that we've had these investors and retail, and even to some extent now, these second-grade hedge funds that have really been saying, oh my goodness, I've got to pile in this market. And so I think the retail investor has really done well here because they've been the ones that have been targeted by the Fed and the government when the government and the Fed has come out and stimulated, right? So they're used to, and they've been programmed since the lows in March 2020 and every subsequent major sell-off, that there's a V-bottom recovery. So if you've been programmed to assume that that will happen, you're going to assume that in this situation it's going to happen again. And it's almost like a self-fulfilling prophecy, right? We're seeing the S&P, this beautiful down move, but then vertical right back up. And hedge funds have now been late to the party. They were sitting in cash. Now they're being forced to chase this into quarter end. We all know the quarter ends the end of this month, and they have to show that their investors that they did well during this recovery period. So I think this combination is driving markets up, but I don't buy that it's going to last here, and I'm going to show you why. So again, remember, I am a chartist, meaning that the charts are what speak to me. I translate it into probabilities. Now, one of my big concerns here is that if we go to that logarithmic chart on the S&P 500, we're still bubbling up against a trend line that goes back to 1929 before the major Great Depression market collapse. And then that same trend line connected to the high of the dot-com era. We just tagged it here. We pulled back. We obviously had a 20%, nearly 20% drop. Now we're pushing back up. So could the markets hit a new all-time high? Absolutely, they could. But this trend line, I have to respect it and understand that every time we've hit it, we've had a major pullback, whether it was the Great Depression, the dot-com collapse, or even this recent drop of 20%. And so again, if the S&P goes up to, let's say, 62 and a quarter to 6,250, I would think that at that point, the markets will see a drawdown. And let's be clear here, folks. The economy is slowing. Yes, the headline labor numbers, okay, sure. Whether you believe it or not, or whether you think that they're going to be revised down or not, we are seeing a slowdown in the global economy and the domestic economy. And at some point, these valuations of these stocks, which are historically very, very expensive, will have to come back to earth. And the charts here are telling us, sure, a little bit more upside, but then watch out for the next flush to the downside.
basically.
So
Yes.
I think the key is you have to just look at the facts, right? So what's different about this time? So number one, we have tariffs, and even if they do these trade deals, remember there's a baseline tariff for everyone at minimum of 10%. And even with this kind of truce with China, it's still 30. I believe it's 30%, if not 40%, that the U.S. has still imposed. So there is going to be tariffs, and there will be as long as Trump is president. The question is at what level. In addition, what about government spending? Right. So we've already seen Doge do their cuts. Now, granted, this big, beautiful bill doesn't really do much, but there are going to be cuts in that bill. In the very least, the spending won't be as maximized as what we've seen prior in previous bills from the government. The deficit essentially probably rises a little bit less, or the debt rises a little bit less than it has been, albeit probably still going higher. So there's this issue now where the government is being much more aware of spending, where they're not just going to flood the market with liquidity. And the Fed is very clearly not quite as aggressively cutting rates at this point. And so what that does is the stimulus from those factors is now missing from the core situation in the economy. And I think that one of the keys too is that we're starting to see the consumer react. Consumer spending is starting to crater a little bit. We're seeing people be much more careful about where they're spending their money. The airlines are saying people are traveling less. That big, huge travel, massive move from COVID has now expired, and people are back to normalized living and being more careful about spending. And we know the consumer is the driving force of the economy. So I think all of these factors are going to lead to a slower economy this time, where stocks will actually have a longer term down move.
With interest rate cuts likely to be delayed and inflation steadily rising, both gold and silver are poised for significant price appreciation. Inflationary pressures often lead investors to move away from paper assets and into tangible stores of value, which reinforces gold's appeal as a reliable hedge, especially if it maintains support above key technical levels and continues its upward momentum. Silver stands to gain even more due to its unique dual role. Not only is it a precious metal, but it is also a critical industrial component. Growing demand from sectors such as renewable energy, electric vehicles, and advanced electronics is creating supply constraints, which, combined with inflation and broader economic uncertainty, puts silver in a strong position for further gains. Against a backdrop of a slowing global economy and rising geopolitical tensions, the attraction to these metals as safe havens is expected to strengthen, driving increased investor interest and pushing prices higher over the medium to long term. That's it for today. Share your thoughts on Gareth's analysis of gold and silver price prediction in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.